Okay, welcome back, Soil Nation, into the Soil Nation headquarters. We're recording live here today with John Greiner from Cat's Grain. As always, my co-host Mitch Hora with Continuum Ag does consulting here in Washington County, and I'm trying to stout seed in Ainsworth, Iowa. So we've been getting a tremendous amount of commotion. There's been a lot in the news lately about the Chinese tariff situation. So we wanted to bring in a specialist for you to talk about that and maybe work through some of the questions that you might be having surrounding
what's going on. Yeah, what
disaster, right?
Are we doomed or not?
Yeah, so John Greiner from Cat's Grain is here with us today. You can find information on John at www.catsgrain.com. Has a really good website. We encourage you to go there and check that out. You guys have markets, and we'll get into a little bit more of what's on that website here. And you also do a commentary on there, don't you, John?
Yep. It's katsgrain.com.
Yeah, that's a good point.
Good point. Cats with a crane.
No, you know.
That's how I would spell it.
Yeah, okay.
Yeah.
Yep. KATS. Yeah, there you go. So, John, why don't you just fill us in a little bit about maybe your backstory and how you got to be.
Well, so I went to Coe College in Cedar Rapids, graduated in 2006, went to work for ADM, did three different locations in oilseed processing and grain division. Then went into business with Katie, my mom, in October of 2007, and been with Cat's Grain since. And she started the grain business in 2002. We basically specialize in sourcing corn needs for our pork producers here in a 3-county radius, and then also buy corn direct from the farmer and move that to processors or other markets. Sure. So that's kind of our core business. And then I became a broker in March of 2009, and that's been growing. And then we also got into the crop insurance business 3 years ago. So interesting times, let's just say that. I would say when we came into, I woke up at 3 a.m. on, must have been Tuesday night, Wednesday morning, and saw the headline online that China had imposed tariffs on U.S. soybeans, corn products, airplanes, all that good stuff. And so it's been an interesting, that Wednesday, seeing the markets instantly down. I think corn was down 16 cents at 3 a.m. Beans were down 48 or 50 cents at that time. So you saw, and then also an interesting thing was that was a record trade volume for the overnight trade. Wednesday morning, before most people were awake. So
as far as trading, like export from the U.S. going to other places, or what's
record trade volume means number of corn and soybean contracts traded on the CME.
Okay.
Yeah, sure.
Had nothing to do with export sales.
Yeah,
but
so just
buying and selling, mostly selling, obviously shorting corn and soybean futures when that news hit.
Yeah, and so we've heard a lot of talk about shorting soybean futures, and do you have any just general thoughts or comments on that? Because a lot of people would say, taking a short contract on December soybeans might be a pretty good idea right now. What's your overall thoughts there?
Well, first people would need to know what short positions are.
People like me.
A lot of people, outside of the marketing world don't probably understand what a short position is. They hear it on the radio or hear it on TV or whatever. But if you're going to take a position, either buy or sell any commodity, you're either going to be long or you're going to be short.
Yeah.
And so what that means is you don't have to, a lot of us think, I'm going to buy soybeans or buy corn, I'm actually buying physical. No, you're just buying basically a commodity asset, a contract, and you can do the opposite. You can sell it. People say, well, what do you mean sell it? I don't own any corn, I don't own any soybeans, and that's okay. You can actually take the short position, meaning you're betting that the market's going to go down. So if you short, say, November soybeans, I think they closed probably around 10:30 roughly today. You can short November soybeans, betting the market's going to go down, and then let's just say November soybeans drop 30 cents, you could actually buy that back to wash out your position at $10. So that would be a 30-cent gain.
Right.
So on one contract is 5,000 bushel. So that would be a $1,500 gain essentially. So when we had a high trade volume like we saw Wednesday morning, we were seeing speculative sellers come into the market. The funds would be taking short bets. And so we saw a big volume there. Short sellers, and the funds are actually holding net long positions right now. They have to report that once a week, every Friday, what their position is. So where they're holding a net long position right now, we also saw them offsetting those positions.
Okay.
And when you talk about them, who is the them that you're talking about that's moving a lot of this stuff?
So the funds is another term you would hear quite a bit. And what the funds are is managed money hedge funds.
Yeah.
If you are let's just say you're a billionaire investor, millionaire investor, doesn't matter.
Yeah.
And you don't want to manage your money, but you want it to go to work for you, you would hire a fund manager or an investment firm. You would say, hey, okay, here's my money. Have discretion over my funds. I want you to earn me a return on my money. Okay, you want me to, and so then it's up to the fund manager where to put that money. Now he may likely puts it into a mixed bag, a diversified portfolio, but a certain percentage of that portfolio would likely be in commodities. And so let's just say 10 or 50, let's just say this fund manager is managing a couple $1 billion. He might have 200 million set aside that he is going to take bets on a certain commodity, and in this case we're talking about soybeans. So that since he is a managed fund, he has to report his net position once a week. And that's just a law that the CFTC sets. The CFTC is the governing body of commodities. So they report those once a week, and so those are the funds.
Yeah, and I think it's worth noting, before we go too far, I think I forgot to say at the beginning, we're recording this on Friday, April 6th. So if we're talking about any numbers as we get into markets here, we're talking about...
Realize things will change between when that we're filming this on Friday and not going to post it.
And with the volatility, a lot can change by Monday.
Absolutely.
Tuesday or Wednesday or Thursday when you're listening to this. So, okay, so shorting the soybean market overall, what's your thoughts then? I guess we understand what shorts are in a sense here. I mean, there is an idea out there that you buy corn right now and short soybeans.
Well, that really looked like quite the good thing. Me and Trent talked yesterday about that. That really looked like the great idea, the great thing to do. And it very well still might be. However, I think July soybean futures today closed at 1046. You'll see on my comment page, on John's comments on our website, that I think I'm okay shorting soybeans right now up here because we have bounced 50 cents from that low Wednesday morning. Soybeans have come up 50 cents. But what's interesting here, since we have put out these tariffs, they're going to tariff 25% of our soybean value on any incoming U.S. soybeans. What's happened here just in the last 48 hours, especially yesterday, is Brazil and Argentina values, their basis values internally in that country have skyrocketed. So like right now, let's just say a farmer wants to sell beans for April delivery cash. He's probably dealing with a 40 under basis, a 40 under July futures basis roughly. What's happened is down there, since all of a sudden, in the matter of one announcement from the Chinese, their basis, let's just say, was, for example, 40 under, which I'm not sure on that exact value, but all of a sudden, the demand for Brazil and Argentina beans from the Chinese just skyrocketed. So they're dealing with much higher internal values. So the price of a world buyer to buy soybeans from Argentina or Brazil just went crazy, just went nuts. So now all of a sudden, if you are another country outside the United States or China that is a buyer, a world buyer of soybeans or soy products, your price, if you want to get them from Brazil or Argentina, just skyrocketed. So are you going to buy a much more expensive product from Brazil, or are you going to take the much cheaper product out of the United States? And so where the idea of, soybeans are tariffed here, U.S. soybeans are tariffed, it did not change the world supply and demand.
It's still there.
So what's going on here is beans have bounced significantly off their lows because all of a sudden U.S. soybeans are now cheap in the world.
Right.
So can China, find alternative, ways to, can they find alternative feed uses from soybean meal, or can they find alternative oils from soybean oil? Yes, they can. And that's what's probably bearish world demand over the long haul if these tariffs stay. But when all of a sudden we have a very cheap product and our export sales up to date are in line with USDA projections, I think one has to be met with caution. Getting overly bearish soybeans, especially when our planting intentions for 2018 were 2 million acres below what the trade was thinking when we came into that last report, March, I think it was last Thursday. So anyway, to answer your question, I think July soybeans can be shorted for probably a 25-cent gain. I wouldn't get any more bearish than that.
Right. And actually, correct me if I'm wrong, just going back to shorting versus buying. When you buy, you want the price to go up because that's how you make money.
Yeah, so you're buying it right now, saying it's going to go up. When you're shorting it, you're saying it's going to keep going down.
Right, so you're betting against it going up. That's in very simplest terms.
Right.
But so soybeans, most people hedge their corn with soybeans or vice versa, right? If I'm going to go buy a soybean contract, I typically buy, 2-to-1? Is that typical ratio?
You're talking about putting on a spread trade, but it's overall, I wouldn't say a farmer puts on a spread trade betting that corn's going to rally versus soybeans. That would be a speculative move.
Okay, so I did read your comments for the day. It sounds pretty optimistic. In your opinion, it sounds like buying corn right now. So you want to explain maybe a little bit on what you're...
Sure. And so the big topic in the headline, I don't care if you're interested in investing in stocks or in the agricultural world, the number one headline right now is Donald Trump versus China. It's U.S. tariffs on Chinese goods versus Chinese tariffs on U.S. goods. And so obviously, I think the Dow last time I saw was down 600 points. Obviously, when we don't, if the Chinese, if we're going to tariff Chinese goods coming in, that's naturally going to make our durable goods, our products, probably a little bit more expensive, especially on the technology side. That's one thing we're really hitting is whether it be their TVs or computer chips, semiconductors, I've read. Tariffing those coming in is probably going to make our devices a little bit more expensive. I guess where I'm going with this is if you're looking for an outlet that seems stable. Obviously, the stock market right now does not feel stable if we're talking about maybe a slowdown in growth. If you look at the supply and demand tables in the world, corn stocks to use ratio right now is the lowest it's been since 2008. So that means our actual world ending stocks, and compare that against what we're using in the world, is as low as it's been since 2008. So we have a tremendous, and then here, this last Thursday, we had a report from the USDA that we're going to plant 2 million less corn acres than we had a year ago. So it's just backwards from what really should happen if we were to maintain corn futures below $4. And right now, July corn, I think, settled at $3.97. So if we're going to maintain prices down here, there puts a tremendous amount of pressure on not only the U.S. coming crop year, but also Brazil just got done planting their safrinha crop, their second season corn. And why that's important is because that's 2/3 of their overall production. Right now their forecast is dry. The next 2 weeks, the southern 2/3 of the country is dry. Over 50% of their growing area is expected not to get any rain. That's fine, they have plenty of moisture. However, they're going to need follow-up rains, not in forecast. Obviously, we don't have the most spectacular start to the U.S. planting season. Historically, the top corn yields nationally come in the years where we get the crop planted in the quickest fashion. That's obviously not going to happen this year. So we have a lot of reasons to be supportive of corn. And so the reason I'm recommending buying corn here is because I think we have a fundamental value. I think we have a fundamental reason to see it trend higher, especially until we have quite a few uncertainties answered. And the reason it's not susceptible to the Chinese tariff talk, which is derailing every market known to man right now, is because we don't sell any corn to China. They do import a very small amount, in the big picture, a small amount of our DDGs and our ethanol. But in the big picture, the United States only exports 15% of its total corn crop. And out of that 15%, none of it goes to China.
Yeah, most is Mexico.
Mexico is the number one.
Yeah.
They import 28% of our exports. Japan would be number 2.
Okay.
So they're not even on the board. And so where we have quite a few things to support the market, obviously Chinese tariffs, scarce things that could lead to a little tiny downtick. I see it as nothing more than a buying opportunity if they retaliate over the weekend. If our forecast for planting looks a little bit more warmer, drier come Monday morning, wouldn't be surprised to see 7 or 8 cents down in corn. I think it's a buying opportunity just because we have fundamental value, and it looks like every other market is highly uncertain.
So what contract out there in the futures do you think is most attractive at this point?
I think if someone's willing to speculate, I would stay with July. If a farmer's looking to re-own some corn that he's been selling, I would stay with July. I'm okay with owning futures. I'd definitely be okay with maybe if your guy's not comfortable with the risk, maybe just buying some July $4 calls. I think they're probably around 13, 14 cents tonight. So.
Okay. So what do you think? Okay, so we talked about corn, we've talked about soybeans a little bit, but what about the livestock markets here? I mean, how do you see this playing in to the hog market, which is big here in Washington County, or even into the cattle futures? Or
Well, they've already reacted. Sadly. Okay. They came out with these tariffs on U.S. pork. I want to say, was it 2 weeks ago? And as soon as that came out, the hog market was already on a nice steady downtrend. I don't mean to call it nice, but and then when that news came out, it really plummeted. And so we saw some short covering yesterday. It took another beat down again today. It looks like it's trying to form a bottom, but yeah, we do export a decent amount of U.S. pork. I think only around 7 or 8% of our U.S. pork goes to China. I mean, it's nowhere near our soybeans. 24% of our U.S. soybean production goes to China. But 7%, it's a decent amount, but is it a crucial amount? No, not necessarily. As far as beef goes, we don't export any beef to China. They approved U.S. beef to be able to export. We haven't sent anything over there of significance. So it's speculation there in the meat markets. I think the biggest thing that's hurt beef is just overproduction. There's just been more cattle kept back, more breeding. Same with hogs. I mean, a lot of it's supply numbers.
Sure.
But also the big dip in the financials is just mentally going to tell the traders that people are going to buy less beef. As long, it's this little scary chatter, but when it comes to the markets, I don't, the meat markets, I don't think guys should be panicking here. I've actually had some people selling cash hogs into this. I mean, just selling cash, meaning they're ready to go, they got to get rid of them, asking me if they should be owning some topside protections because they hate to sell into this time of down.
Right.
And here, we're seasonally, we tend to find a bottom right now. I say absolutely. As long as you're okay with the risk and if you're selling cash into this, seems like things couldn't be any more negative. Eventually someday people are going to go back out and grill again. Someday people are going to go back out and consume more.
Sure.
So yeah, this is not a time to panic sell, and if you do have to sell into this, I would be against owning either some calls or re-earning the futures in here, as long as you understand the risk.
Sure.
This is some wild stuff.
Yeah,
this is like all stuff for me. I just sit back here and listen to I took a class on this up at Iowa State, but it's still wow, this is just crazy stuff as my aim on a farmer that when it's time to sell, we call up Katie and say, hey, we gotta sell, the markets look good, hey, we're gonna sell it on this day or whatever, send the trucks, and that's about it, but there's so much more to it, and a lot more of the game that you can play if you want to really learn about it. And so that's what's interesting to me, to talk about what are all those other options and ways to to get around it, because when we're talking about, you know, marketing grain and stuff, a lot of times you're selling into the market, and then it is what it is.
Right.
And you can maybe, you know, you can do things a little smarter so you can get the best dollars you can. But we've been talking a lot about how do you take control of more of that on your own with direct marketing kind of stuff. It being one place to try to get a better dollar figure if you're kind of marketing into special markets on your own. So that's one way to try to get a better bottom line. Other way is, to do some of these options and whatnot. And there's risk to all of that, of course. So interesting just to, you know, to talk about on how that all works.
So as a reminder, we're talking with John Greiner from Cat's Grain. Cat's Grain is located in Washington, Iowa. You can find a lot of information on their website.
Yeah.
Cat's Grain, KATS grain.com. So there's a comment out there that we hear quite a bit in that we have the world's greatest producers and sometimes the world's worst marketers when it comes to farmers. So maybe just like, what's John's basics for a guy to understand right now, maybe as he's, you know, if you were going to give somebody advice that was a new farmer that was, okay, this is how, just some things that you can do to really try to be better at marketing,
Well, a lot
and just always dumping when you need cash, right?
Sure.
So maybe do you have anything that you'd pass along just on some?
Yeah, and it doesn't have to be overly complicated. And this isn't to try to advertise, really isn't, but on our website, I post the latest supply and demand tables. And I think when it comes to marketing your commodity, if you are a grain producer, so your business, your job is to understand your own fundamentals, right? To understand your market. It's like if you work at a factory, you understand you're supposed to be at work from this time to this time, and you understand what you're going to get paid. It's no different when you're a farmer, it's just a little different. Your hours aren't set, but your fundamentals are always changing. So I mean, it's just kind of the biggest thing I would recommend is to know the supply and demand. We post those tables that the USDA comes out with once a month. Understand supply and demand. Understand what our carryouts are. Understand what our usage is. We have that on our website. I post the world supply and demand tables for corn and beans. I have the U.S. domestic supply and demand tables on there. You know what our usages are for corn and beans, whether that be exports, soybean crush, feed usage, whatever. So getting a hold of that. We do offer Cat's Grain customers text message services where 4 times a day we'll text out what the markets are doing. It's not that you need to always be on the cutting edge of what the market's doing, but we do send out weekly export sales. Know if we're selling what the market expects. We do text out these USDA reports, what the market's expecting versus what it actually was reported. You can also access the NOAA, the National Weather Service, 6 to 10 day, 8 to 14 day forecast. Those models change once a day. Take a look at those. Know your seasonalities. Obviously right now, cool and wet would be supported or bullish the market. But yet, once we get into July, cool and wet would be absolutely bearish. Have an idea what the weather forecasts are. You also have access to the drought monitor. Have an idea, and then I also have access to maps on where the main, a map of the United States, where the corn acres are, where the soybean acres are. Then look at the drought monitor, see if those areas are dry or not. Are they forecasted to get rain? So there's a lot of simple tools that can all be accessed from our website. So just have an idea on the weather, where the key acres are, your supply and demand.
Sure.
And then just, subscribe to our text. Right. And just to me, and then the market's going to tell you itself, and you have it. And I always tell people, know your bottom line. Mm-hmm. Know what your cost per bushel is. Mm-hmm. And when you're figuring new crop, plug in your APH. Most people carry crop insurance anyway, so plug in your 5-year APH. Know your input costs. Know your bottom line. Yeah. If you're at profitable levels and the market has come up, you need to be making an incremental sale. If the market goes down and you're below your cost of production, hold off.
Yeah.